Hello everybody, welcome back to another episode of the Investor Motivation Podcast. You are being talked to today by Amy and Robert.
How are you, Amy?
Is that the right thing to say? Talked to today by?
It'll do.
We are talking to you all.
Yeah, I would do. As long as we're doing it, that's the main thing.
Yeah,
Very
that's
good.
right.
What are we chatting about?
Today we're going to talk about the super tax changes. So the government have re-proposed some rules around super. So previously it was that member balances above $3 million in super would be taxed an additional 15%.
Cool.
They've revised that slightly to say that there's going to be another cap on anything above $10 million in super with an additional 10%, so essentially a 40% tax rate there.
And there was that was new, and obviously one of the big changes they made was around the being taxed on unrealised capital gains, which was unprecedented, unfair, and a yucky tax.
Yeah, this common sense change, really.
Well, that's right. I've heard a lot of people be quite negative about I suppose the government on this, but I sort of see this as, many people are stubborn. And once they've made their mind up and they try to get something through, for them to unwind their thinking and not be as stubborn, for me, that is excellent. That is listening to the community. Yeah. So I see that as a positive thing where people can change their mind. It's like us, if you have biases towards a business, a bad business, we need to be able to have flexible thinking to change our mind. Yeah. So I see that as a very good positive, that they are listening to the people. Yeah,
absolutely. And then the other big change, so not only have they reversed taxing unrealised gains, they previously weren't going to index up those thresholds of the 3 mil and now the 10 mil, and now they have introduced indexation. So
fantastic.
It won't happen every single year, but it'll happen like the super contributions cap, so jumps when the CPI reaches a certain level, which is great.
Let's just cover off on the rules themselves, and we'll talk broadly about superannuation. And for those that have over $3 million in superannuation, well done.
Per member.
Yeah, and that's a key point.
Yeah.
It is per individual. It's not a couple. So we look after close to 300 self-managed superannuation funds. And people are looking at their funds as a couple and saying, oh, geez, we've got $3.5 million, we're in trouble. No, you're not. It's an individual basis. It's not based on the fund value itself. Yeah. When you look at your self-managed super fund, you'll see one big bicky barrel with all the assets, and when you get your tax return, that's where you'll see member A, member B, member 1, member number 2, whatever it is. Yeah,
so that breakdown per person.
Correct. So these are really positive changes. I think there will be around 90,000 people that it will affect.
It's about 0.5% of the population, so we're not probably speaking to a large audience today, but I think it's important to know for everybody.
Absolutely. And for young people, our goal should be to do our best to max out these caps. And the people that are over the new cap, I saw a number on this, that the new cap that we hadn't heard about, that
the 10 mil.
The 10 mil. So just explain that one, Amy.
So at the moment, the proposed rules will be that balances under 3 mil will continue to be taxed as per superannuation rules, which is 15%. Anything between 3 mil and 10 mil, the income associated with that balance will be taxed at an additional 15%, so effectively 30%. And then balances over 10 mil, income proportionately on that balance will be taxed at 40%, which is an extra 10% again.
Yeah. So apparently there's around 4,000 individuals that are in that space. And you'd be wondering, how on earth do you get there? Now, that's happened within our area here, and that's predominantly been because of people put in farming land, 10, 20, 30 years ago. And like all assets globally, whether we're talking any asset, gold, share market, residential property, commercial property, even non-assets like crypto, that'll fire up a few people. Every assets are at all-time highs. Things became so significantly overvalued locally here from a farming point of view, farming land. So that has caused big problems where there's the values go up significantly. The value within a super fund dictates what needs to come out each year based on the minimums and the maximums, minimums mostly. And of course, the higher any asset goes up, and the income doesn't change that much, the yield doesn't go up, that causes liquidity problems. So we've been dealing with that over the last heap of years to deal with that. So what we'll do is we'll go through an example to sort of explain how the taxes are apportioned across the income.
Yep.
And then we'll look at, okay, for those that are over, what other options might they consider?
Yeah.
And, when we start to break down to say, well, what are the individuals taxed at? What other options do they have once they get over certain levels?
Yeah.
But let's go through an example, and Amy, I'll let you run off with the example because we're trying to make this as simple to follow because this is a podcast.
Yeah.
So we're going to talk in big, broad numbers that allow us to break things down easily.
Yeah, and it's really painting a picture. It's not saying that, anyone has this amount of money or receives this kind of income in their super fund each year, but we've just gone with a member balance. So an individual in a self-managed super fund will have $20 million as their balance, so good on them.
And 20 million means that we've got $10 million you're at that new rate.
Yep, so with the new rules, if someone has $20 million, we'll assume that they've generated $1 million of income in a financial year. That income is now split proportionately based on their balances over the threshold. So under $3 million, tax generally, so 15%. 3 to 10 million, which is $7 million in that area, will then be taxed with an additional 15% on it, so at 30%. And then over $10 million, it's 50% of the fund because it's 20 million of the member balance, at 40%.
Yeah, and this is the income and also realised capital gains.
Yes.
But there are some extra rules around capital gains where there is a discount when the asset's been held for more than 12 months.
Yeah.
So that's a bit of a practical example. So as I said, there's very few people that would be in that space of 20 mil, but we just use that number for simplicity to show that, on a 20 mil fund and $1 million of income, $500,000 will be taxed at 40%.
Yep.
So it's apportioned based on what money you've got in what
percentage.
scale.
Yeah.
Yes.
It's hard to talk about proportions verbally without showing it, but it is really just proportioned and balances above those thresholds.
Yeah. Actually, it's probably going off tact a little bit, Amy, but caught up with the clients that we're looking to move our business.
Yep.
And they were essentially going from bespoke, the way we manage our client portfolios, to one size fits all, built for scale. And what I mean by built for scale, that is built to make the financial planning business efficient rather than good for the clients. Yeah. Now, one thing that the advisors didn't cover off, because it wasn't as if they were unhappy with this, they just thought, well, if our accountant does this and super fund, they can look after the investments as well. What they didn't know, there's nearly a 40 grand capital gains tax liability. So
if they were to move everything.
If they were to sell down, which was the advice, and move over to here. And I've let them know, and I've caught up with them, everything's fine, they will be clients for many years to come. But they got an email back saying, and this is a fund of about 1.7.
Yep.
So and this is a couple, so they're nowhere near any of these limits. And the accountant got back and said, we could smooth out the capital gains by selling it over a number of years. And I said, well, there is no scaling normally within superannuation, is there? Yeah. It's 15%.
Correct, yeah.
And so it doesn't matter when you sell it. It's always going to be 15%. So nice try, but that doesn't make any sense. But when we're getting over 3 mil and 10 mil, there is some scaling now.
Yeah, definitely.
Yeah.
There will be a new strategy that needs to be thought of if these rules do come into play. And there is still some grey area, so it's greater if you trigger that realised capital gain after the rules.
Yes.
Are you only being taxed on the gains that were generated after these rules come into place, so after the 1st of July 2026, or is it gains that have accrued in the entirety of the fund's existence?
Right. Okay.
So that's still grey. And
if they do the right thing and say, well, it's from this date onwards, that just creates this whole new level of complexity of pre-capital gains from this date, and so they may not do that.
No, they may not.
Yep.
It is a strategy. Should we then be triggering some gains prior to these new caps in that world? So if it was someone wanted to fully sell down their portfolio and move it elsewhere, that's when you need to start thinking about this stuff beforehand.
Cool. You're ahead of the game, Amy. So let's say that people are well over the 3 mil.
Yep.
So well
20
done.
mil balance.
Well, that's probably a bit generous, but there's a bigger fund, and let's say they've got no assets in their own name. So we're thinking about, okay, I don't want to pay tax at 30%, where we're 20 mil or we're over 3 mil. We've got to consider what are other entities that we can own assets in, and what are the tax rates of those entities. So can you go through, I suppose, when I say entities or tax entities, who and what am I talking about?
So the most simplest entity would be the individual, so just a person.
Right.
If they're, if we're talking about retirement phase and they're no longer earning an income, then that's a great spot to have assets that can generate that passive income. Seniors especially can earn around $23,000, $24,000 individually tax-free, so that's an amazing spot to invest. And then it's just the individual income tax rates thereafter that we've always had.
So that's scaled again.
Yep.
So that's where there is some scaling. So if it's within that 25, 30 grand, or whatever the number is, and it's tax free, then you take them up to that level. Before you consider, and this can be individually or jointly held, of course. So we probably need to be a little bit forward thinking as well, and think about the ages. That if someone, someone will pass away and all that income that was going to 2 people goes to 1, what problem does that cause in terms of tax? And this is where perhaps the next structure, or probably favourite structure in Australia for being able to distribute income across many people.
The discretionary trust,
Yes.
family trust, So that again is, once you've probably maxed out the individual capacity and you don't want to cause a tax problem for that individual, or you are doing that forward thinking, you can go to the family trust, which can house all of the assets, and then any income received or generated by that trust can be distributed to a list of beneficiaries. So that can be the person who set it up, their spouse, their children, their parents, really anybody that they choose to nominate, so that you can decide year on year how to distribute it in the best tax way.
And obviously everyone's thinking about their children and future adult grandchildren. You've got to be careful around any Centrelink entitlements that they may receive, family tax benefits. Obviously I'm not in that world of giving that type of advice, but there is a flow-on effect if you distribute income to someone that's receiving an age pension. That will have a significant negative effect. Because of the income test. So, one action can create problems. So you need to get special advice in that area. But, if I suppose thinking about it, it's probably not so much the value, but it's more about the amount of income.
So whatever income that generates, and of course we go for businesses for growth. So it's more about generating growth of the value there, less, yield increasing businesses. So it depends on the way you invest as well. You can do different ways. And
what's Amy's saying there around that when we're selecting direct businesses to purchase for our client portfolios, we are not motivated by seeking high dividend paying. We want just high quality businesses that might pay a small dividend but keep a lot of that money to rebuild, not rebuild, to reinvest back into the business to improve products and services over a long period of time. Fantastic. I think we've covered off this pretty well. We could also talk about companies that can, a beneficiary company that can be, once you've maxed out all the beneficiaries, where you say, well, I'm not going to pay over $135,000 to the beneficiaries that are there. I now want, that's the 32% tax rate. Once you go over that, you go into a higher tax rate, 39% with Medicare. That's where you might set up a beneficiary company, and the tax rate there is now 25%. But there's complexities with companies, and obviously with trusts and companies there is tax returns, more layers of complexities for the family
and costs there.
But these things aren't. These are common.
Absolutely.
So find a good accountant. They don't have to be difficult.
No. And even further on that, on top of family trusts and companies and the individuals, there's investment bonds and education bonds. So when you are thinking about that future grandchildren, there are also alternatives there. So there's a lot of different ways to skin the cat, essentially.
Yeah, and probably one thing one option in terms of gifting to, giving the head start that our kids may need.
Yeah.
Well, not may need, probably will need to be able to buy a house in this place.
Yep. In
this place of Australia that's really expensive and debt levels are so high.
Yeah.
Making provision for children, grandchildren, how do we help them?
Yeah.
And obviously there's a whole raft of strategies that we've probably covered off in the past and we probably won't get time to do today.
No, keep it simple on super this time.
Yeah, very good. And not so distracted as I get. Amos, thank you very much. Where can people find you if they want to know a bit more and see you in action about the stuff that you believe in?
Yeah, you can catch me on TikTok, Instagram, Facebook, LinkedIn.
Yep.
Amy Lehman FA is my handle. Just make sure you do Amy Lehman FA and not another A on the end, because there's people out there impersonating as well.
Well done. You're in that world where people are impersonating you.
Sadly.
Yeah, it's a complexity that you wouldn't think would happen.
Yeah.
Yep. And I'm on TikTok and Instagram, and I'm not sure where else.
You're just Robert Gowdy.
Robert Gowdy Financial Advisor on Instagram. There are fake accounts there. There's lots of fake accounts on TikTok. My handle there is Rob _ Gowdy on TikTok. But the one thing I say that I will never message anyone directly.
Yeah.
People can message me and I'll get back to them if they've gone to the effort, but you won't receive a message from me particularly saying that we'll be trading cryptocurrency.
Yeah.
People know
Sending
me.
money.
That is not me. Cool.
Perfect.
Thanks, Amy. Thank you, everyone, for listening. If you have a topic that you would like us to cover, we're more than happy to have a crack at that, because we love learning and being challenged. So
Please send it through.
Yeah, fantastic. Thanks, everyone.
Bye
Take
for
care.
now.
Bye.